I woke up today and something felt off. Not in a dramatic end-of-the-world way, in a quieter way. The kind of off that only shows up when you look at your portfolio and realize everything is moving like it's connected to the same invisible string. Stocks feel jumpier. Bonds don't behave the way people expect. The dollar has moods. Gold can't decide what it wants to be. And the weirdest part is the headlines keep telling you these are separate stories. They're not. There's one story sitting underneath a lot of this. And it starts in a place most people stop paying attention to because it sounded boring. Japan's bond market. Yeah, Japan. And before you click away because you think this is going to be a nerd lecture about yield curves and central bank jargon, let me make you a promise. I'm going to explain this in plain English, with zero fluff, and you're going to understand why your portfolio has been feeling the way it's been feeling. Because when Japan's bond market is back in control, that doesn't just stay in Japan. It changes global money behavior. It changes where capital hides, where it takes risk, and what gets sold when pressure hits. So today we're doing three things. First, what Japan's bond market back in control actually means in human language, not economist language. Second, why that can spill into your portfolio even if you've never bought a Japanese asset in your life. And third, what I'm watching next, measurable signals, so you can tell if this is a short-term tremor or a longer-term regime shift. Quick check-in before we start. Comment one word, risk or safe. Which mode do you feel like the market is in right now? One word. Then we move. All right, let's start with the simplest version of the story. For a long time, Japan was the land of nothing moves. Low rates, low growth, low inflation, and their bond market was basically treated like background music. But behind that calm surface, Japan's bond market was doing something huge for the global system. It was acting like a cheap funding engine. Here's what that means. If money is cheap in one place, and you can borrow it cheaply, you can take that money somewhere else and buy higher-yielding assets. That's not a conspiracy. That's basic incentive. Borrow low, invest higher, collect the spread, and when a lot of big institutions do that, it becomes a global habit. It becomes a pipeline. People don't talk about it at dinner because it's not sexy, but it matters because it changes the background pressure on markets around the world. Now, when people say Japan's bond market is back in control, they're usually describing a shift in that pipeline. They're describing a world where Japan's rates and yields can move more freely, and the central bank is less willing or less able to keep the cost of money artificially pinned down forever. In plain English, money from Japan may not be as cheap as it used to be, and the rules of the pipeline are changing. That sounds like a Japan problem. It's not, because when the cost of borrowing in Japan shifts, it can change global flows. And global flows change prices everywhere. Here's the mechanism, plain English. If borrowing becomes more expensive in Japan, or if Japanese yields rise enough to look attractive at home, some big players who used to send money abroad start rethinking it. They don't need as much foreign risk if they can get a better return at home with less currency risk. So capital that used to flow outward can slow down, or even reverse. And when big flows reverse, markets don't politely adjust. They reprice. That repricing is what your portfolio feels. It can show up as higher yields elsewhere because bonds have to compete. It can show up as pressure on certain stocks, especially the ones that were priced for easy money. It can show up as currency moves because when people unwind positions, they often have to buy back the funding currency. It can show up as why is everything correlated again? Moments where good news doesn't rally the way it should, because the driver isn't company fundamentals, it's flow. Now let's make this concrete with a simple picture. Imagine a lot of global money has been living in a trade that works like this. Borrow cheap in one currency, invest in higher return assets elsewhere, and assume volatility stays manageable. As long as the funding stays cheap and stable, that trade hums. But when the funding gets more expensive or more volatile, the trade gets uncomfortable. And when it gets uncomfortable, people reduce it. Reducing it means selling the things they bought elsewhere and paying back the borrowing. That's the portfolio feels it part. Because it's not about you owning Japanese bonds. It's about you being invested in assets that were supported by global liquidity habits that are now getting challenged. Now let's talk about the phrase back in control, because that can sound like propaganda unless you define it. Back in control doesn't mean everything is safe now. It means the bond market is asserting itself again. It means yields are moving in ways that reflect real supply, demand, and inflation expectations more than pure policy suppression. It means volatility can return. And bond volatility is not a niche thing. Bond volatility is the steering wheel of the global market. If you want one line that sums it up, when bond markets get loud, everything else gets nervous. Because bonds set the price of money, and the price of money sets the price of risk. Now why does Japan matter so much? Because Japan has been one of the biggest sources of global savings and a major participant in foreign bond markets for decades. Institutions in Japan have owned huge amounts of foreign bonds, and the funding dynamics around Japan have mattered for global carry trades. You don't have to memorize the details, you just have to understand the direction of pressure. If Japan becomes a more attractive place to keep money at home, less money needs to go hunting abroad. And when less money goes hunting abroad, the assets that benefited from that hunt can feel it. So let me translate that into portfolio language. If Japan's bond yields rise and domestic returns look better, you can see pressure on long-duration bonds in other countries, because global demand shifts. Growth stocks that were priced on low discount rates because higher global yields change valuation math. Riskier credit, because easy liquidity becomes less easy. And sometimes even commodities or gold, because the dollar and real rates dance in response to global flow changes. Again, this is not a Japan is the only thing that matters claim. This is a Japan can be the hidden lever that changes the background environment claim. Now here's where most people get confused, because they want a single villain or a single hero. They want to say this is good or this is bad. Markets don't work like that. A return to more honest pricing in bonds can be healthy long-term, but it can be painful during the transition because portfolios are built on assumptions, and the assumption that dominated for years was, cheap money stays cheap. When that assumption gets questioned, everything reprices. Now I promised no lecture, so let's keep it moving and get to the part that actually helps you. What should you watch next? Because Japan bond market can become one of those phrases people throw around to sound smart, and it's useless unless you turn it into signals. Here are the measurable signals I'm watching, and you can watch them too without being an insider. First, the direction and speed of Japanese yields. It's not about the exact number. It's about whether yields are grinding higher steadily or snapping higher in bursts. Snaps matter because snaps trigger de-risking. Second, the currency reaction. When big trades unwind, the funding currency often strengthens because people buy it back to repay borrowing. If you see sudden strength in the funding currency alongside rising domestic yields, that's a clue of unwinding pressure. Third, foreign bond demand behavior. You'll see it indirectly. If foreign yields rise despite good news, it can mean a big buyer is stepping back. Markets don't need to crash for that to matter. A slow withdrawal of demand can change the environment. Fourth, correlation behavior. When flows dominate, correlations rise. You'll notice days where stocks and bonds fall together, or where the market ignores positive headlines because the driver is repositioning, not fundamentals. Fifth, volatility in rates markets. This is the one people ignore until it hurts them. When rate volatility rises, it changes risk appetite across the board. It's like turning up gravity. Now, what does this mean for you personally? It depends on what kind of portfolio you run. But there are a few universal truths. Truth 1. If your portfolio is built on the assumption that rates always fall when things get scary, you need to recheck that assumption. In some regimes, bonds hedge stocks. In others, they don't. When inflation and policy credibility are in play, correlations can change. Truth 2. If you're heavily concentrated in long-duration assets whose value is sensitive to discount rates, you're more exposed to global yield repricing. Truth 3. If you've been relying on easy liquidity as an invisible support, you may feel the floor get less bouncy. Now, I'm not telling you to panic sell anything. I'm telling you to update your mental model, because the most expensive mistake in markets is fighting the regime. Now let's address the title again. Japan's bond market is back in control, and your portfolio feels it. If you want the one-sentence translation, it's this. When Japan's cost of money shifts, global risk has to reprice, because cheap funding and cross-border flows were part of the support structure. That's the core idea. Now I want to add one more layer that most people miss. The market doesn't move just because something changes. It moves because positioning gets caught on the wrong side of change. If everyone was positioned for Japan stays quiet forever, and Japan stops being quiet, then the adjustment can be sharp, not because the world is ending, because the trade was crowded. So what happens next? Here's the honest scenario tree. 3 lanes. Lane 1, it stabilizes. Japan yields settle into a new range. The market adapts. Flows adjust gradually. This is the smooth transition version. Lane 2, it accelerates. Yields rise faster. Volatility increases. And unwinds spill into global assets in a more obvious way. That's when your portfolio feels it more acutely. Lane 3, it whips. The market can't decide. Policy signals conflict. Volatility stays elevated. You get chop good days, followed by weird days. This is where people make emotional mistakes. So don't try to predict the exact lane with certainty. Watch the signals and manage exposure so you're not crashable. And that brings me to the simplest rule I can give you in any regime shift. Don't let your position size turn you into an emotional hostage. If a move in yields can ruin your sleep, you're oversized. Reduce it. You'll think clearer. Now, one comment prompt, and I'm keeping it to one, because too many prompts lower compliance. Which do you think hits portfolios more over the next few months? Rates or currency? One word. Rates or currency. Now let me wrap this up cleanly. Japan's bond market matters because it influences the global price of money and the direction of cross-border flows. When that foundation shifts, assets that were supported by cheap funding and steady demand can reprice. That doesn't guarantee a crash. It doesn't guarantee a boom. It tells you the environment is changing. and environments are what portfolios swim in. If this helped you, subscribe. I'm going to keep breaking down the boring levers that secretly move everything, in plain English without the drama. And send this to one person who keeps saying Japan doesn't matter. Not to dunk on them, just to save them from being surprised by a lever they weren't watching. Educational only, not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and don't let the market's hidden levers catch you asleep.